According to Rob Kirby, these type of moves of gold and silver have just an immense, way too much correlation, and this is going down. But of course, we've seen prices go up with the same type of manipulation, and that to him and to the statistician Jim Willie means that the gold and silver prices are completely rigged. They're completely artificial. They have no relationship with the real supply and demand at all. And basically they're rigged and manipulated by JP Morgan and Goldman Sachs, and these banks are either controlling the government or the other way around, and that has been going on for a long time, and that raises some ethical questions, and I want to talk about it in another video, but take a listen to Rob Kirby.
And most people would know that I often write about manipulation in markets, and it's just that my mindset and my way of thinking was always that the manipulation and the interference was always on the downside, or capping in nature, in that when gold and silver or silver went too high, the heavy hand of the Fed or Treasury or their agents would come into the market and knock prices down. But what these charts are telling us, and the degree of correlation between how they move in lockstep, both on the upside and the downside, reek of, it reeks of the fact that these markets are rigged not only on the upside but on the downside. And what it basically means, and what it implies, is that computers are being used to generate trade volume that allows people, or whoever is behind this rigging, it allows them to put or place the price of precious metals wherever they want at any time. And the ramifications of that are stunning.
Yes, let's do talk about those ramifications, because there's you can't. First of all, let's talk about the natural probabilities of something like this happening in two totally independent, seemingly, allegedly free markets. Let's talk about that first. And what do you think the likelihood of that happening is? I mean, I have a pretty good guess what you're going to say, but let's throw it out there.
Well, if you scroll down yet a little bit further in the article, you will see an exchange that I had with Jim Willie. Now, Jim is a PhD in statistics and a completely brilliant statistician. And when I first saw these charts and saw the degree of correlation and the way they trade lockstep, I said to Jim, could you give me an idea what the odds are that two markets that are alleged to be free markets could trade in such lockstep fashion, the way these charts show? And Jim's response to me, as you can read in front of you if you've got the article up, he just said, Rob, it's impossible that these chart patterns could occur without being completely and utterly planned or rigged. So that is, I'll take that as being sort of a nail in the coffin, that this is just a complete and utter rig job. The fallout from this, which is stunning, if you know a little bit about the people that are behind this degree or this kind of market rigging, the suspects are basically the U.S. Treasury and Federal Reserve. And anybody that follows the U.S. Treasury and Federal Reserve, like I do and like Jim does, they know that their chief agents are primarily two financial institutions, J.P. Morgan Chase and Goldman Sachs. But J.P. Morgan Chase and Goldman Sachs are institutions whose trading prowess is unequaled anywhere in the market. And these guys make more money out of trading consistently, quarter in, quarter out, than any of their peers on the street. And everybody